Welcome to the third video in your Social Security and Retirement Income webinar series. In this section, you will learn how Social Security interacts with other types of retirement income. The advisor that you work with can help you coordinate Social Security and your other retirement income streams to determine which account to draw from and when to avoid tricky tax situations. Now that we've established the basics, let's look at a few more complex scenarios. But first, a couple of disclosures.
In this last section, we'll talk about coordinating Social Security with your other retirement income streams. This is a chart of the cash flows coming in under the Both Claim Early strategy. You can see it's pretty level, and it's pretty easy to see that you need a level withdrawal from other assets in order to bring the total income up to the red line, which is the desired income. But when you implement a Social Security strategy, you see a pretty different pattern of cash flows hitting the household. In this case, there's a larger gap at the front end, then a much smaller gap during the client's lifetime, and a considerably smaller gap for the survivor. Advisors who have worked with this sort of planning are much better equipped to understand and recommend appropriate retirement products to help you build that retirement income. Now we're going to talk a little bit about the taxation of Social Security benefits. It's common among financial advisors to say 85% of benefits are going to be taxable. And for high income earners, it's often the case. But for many, you can achieve some incredible tax efficiency by consciously blending Social Security with other income streams. Calculating the taxable portion of Social Security benefits is actually a two-step process. The first step is calculating your provisional income. Your provisional income includes 1/2 of your Social Security benefits, plus all other taxable income, including dividends, realized interest, and realized capital gains, plus any non-taxable interest earnings, such as that from municipal bonds. The next step is to apply taxation thresholds. For a single person, each dollar of provisional income from our first step that falls over $25,000 creates 50 cents of taxable Social Security benefits, and each dollar over $34,000 creates 85 cents of taxable Social Security benefits. The thresholds for a married couple filing jointly are $32,000 and $44,000 respectively. Interestingly, for a married couple filing separately, 85 cents of every Social Security dollar is taxable. A Social Security carries a substantial tax advantage over other forms of income. So delaying benefits in order to build a larger Social Security benefit can have a greater positive tax impact than most people realize. Let's take a look at this first example. In this first example, $20,000 of Social Security benefits with a $40,000 IRA withdrawal. Take half the Social Security benefit and add it to the other income, and we get $50,000 of provisional income. Subtract out the first threshold, and this is for a married filing jointly, and we're $18,000 over. Multiply that by 50 cents for each dollar, and we have $9,000 of taxable Social Security benefits based on our first threshold. We then subtract out the second threshold. We're $6,000 over the second threshold. Multiply that by 35 cents because we already picked up the first 50 cents on step one, and we're $2,100 over there, which means our total taxable Social Security benefit is $11,100. It's only 55%, not 85% of the benefit is taxable in this particular instance. Now, if we flip that example on its head and we have a larger Social Security benefit, in this case, $40,000 of Social Security, and the same $60,000 of overall household income. So we've got a $20,000 IRA withdrawal. Take half the Social Security benefit, and that gives us Take half the Social Security benefit and add it to the IRA withdrawal, and that gives us $40,000 of provisional income. We're $8,000 over the first threshold. Multiply that by 50 cents on the dollar, and we get $4,000 of taxable Social Security benefits. We're not over the second threshold, which means the total taxable benefit is $4,000. Only 10% of the overall Social Security benefit is taxable. That means $36,000 is coming through completely tax-free. In fact, it's not even hitting the tax return at all. And when we bring these examples onto the return, here's what it looks like. That $40,000 of IRA withdrawal plus $20,000 of Social Security creates $11,100 of taxable Social Security. We add it to the IRA withdrawal, and we get total taxable income of $51,100. We subtract out the standard deduction plus the additional deduction for over 65, and we end up with $27,400 of deductions, and our net taxable income is $23,700. Most of that falls into the 10% bracket. A small amount falls into the 12%, so the total tax bill is $2,449. In our other example, we only had $4,000 of taxable Social Security benefits, and when we add that to the $20,000 of IRA withdrawal, we're still below the standard deduction, which means there's no federal income tax at all. And keep in mind, that tax efficiency is a tax efficiency that can last decades in retirement. Now, if you've already filed but you're within 12 months of that initial filing date, you can actually take a do-over. If you're outside 12 months, you can suspend benefits between your full retirement age and age 70, which would increase your benefit by 8% per year. And that'll help for some, but keep in mind during a period of suspension, no one, including a spouse, can take benefits based on your record. So it's really important to get the decision right the first time, but if you didn't and you happen to catch it early enough, you can still take steps to improve your situation. Now, why wouldn't we just ask the Social Security Administration for advice? Now that you've got a good idea of what should go into a Social Security claiming decision, you might be asking, why not just go to Social Security for advice? It's a good question. First, it's a question of perspective. Financial advisors with Social Security as a key element of their practice are looking to organize your overall assets to get the most from them over your lifetime, or if you're married, over the joint lives of you and your spouse. Social Security personnel are trying to get to the highest monthly benefit they can get you on the day you come into the office. It's a very different perspective, and a different perspective gets you very different results. Second, Social Security personnel are actually precluded by their own rules from giving advice. And third, they can't ask you about outside assets. Obviously, how you take Social Security impacts how you use other assets. So missing this piece doesn't get you where you need to go. This is what we do. We help clients get more from Social Security as part of your overall retirement income strategy. We help you use those assets appropriately to create an overall retirement income strategy that is likely to help you reach your goals throughout retirement.